Welcome to the Chapter 3 Lecture Series, Part 10. This is going to wind up being the last of our series. First, learning objective, compute profit margin, and describe its use in analyzing company performance. Profit margin is an important measure in business. It tells us about the relationship between sales and profits or net income. We calculate the ratio by dividing net income for the period by sales revenue. A high profit margin is an indicator of future growth. You can see the profit margin at Limited Brands for years 2011 through 2015. Limited's average profit is 8.3% during this 5-year period. This favorably compares to the average for the industry profit of 2.3%. Moreover, we see that Limited's profit margin has rebounded from the recent recessionary period and is at the 7% to 9% margin for the past 5 years. The formula for profit margin, again, is net income divided by net sales. And net sales would be minus any discounts, returns, and allowances that might have been offered. Compute the current ratio and describe what it reveals about a company's financial condition. An important use of financial statements is to help assess the company's ability to pay its debts in the near future. Such analysis affects decisions by suppliers when allowing a company to buy on credit. It also affects decisions by creditors when lending money to a company, including loan terms such as interest rate, due date, collateral requirements. It can also affect the manager's decision about using cash to pay debts when they come due. The current ratio is one measure of a company's ability to pay its short-term obligation. It is defined as current assets divided by current liabilities. Now remember, when we talked about the classified balance sheet, we said that current assets are assets that were going to be consumed within 1 year or the full accounting period. The same with current liabilities, liabilities that are due within 1 year or the current accounting period. Not total assets and not total liabilities. Limited Brands' current ratio averaged 1.8 for its fiscal years in 2010 through 15. The current ratio for each of these years suggests the company's short-term obligations could be covered with short-term assets. However, if its ratio approach would be 1.0, Limited would expect to face challenges in covering its liability. If the ratio were less than 1.0, current liabilities would exceed current assets, and the company's ability to pay short-term debt obligation would be in doubt. Limited Brands' liquidity is evidenced by its current ratio. It declined in 12 through 13, which roughly matches the industry decline.